Now that you understand what shorting is, the themes and concepts that go around it, we're going to take a look at the anatomy of a short squeeze. So we're going to figure out these body parts, and when these body parts are put together, they're going to form a very attractive setup for us sitting on the long side of the fence. First thing in the video we're going to cover is just simply what is meant by a short squeeze. We're going to talk about why is it even worth caring about, and that all revolves around the need. Then we're going to check out the phases that are involved in a short squeeze, the building, the transition, and the trigger point. We are then going to look at a major problem, followed by looking at some risks, and then we'll check out some examples that show short squeezes in just an overall fashion. So you know what short is, but what the heck is a short squeeze? Well, let's remember back to the what is shorting video, and assuming you're going through the recommended viewing order, hopefully you've already watched it, but an agreement has been established, and with that agreement it must be met. And remember, stocks can only go down to zero. So us as longs, the biggest loss we can have is just whatever we put into a trade. But as far as shorts are concerned, because the stock can go forever, trade losses can also be forever. So keeping that in mind, a short squeeze is when traders who are short need to cover. So that need to cover is where the squeeze part comes. So if you're just out and about, or maybe talking to other traders, and they say, hey, the shorts are being squeezed, that just implies that the shorts are needing to cover. All right, well, that's all fine and dandy, but how is need being defined? Need is a pretty broad term. I could say, hey, you need to visit such and such place, and at the end of the day, who am I to say that? That's a very subjective and a very, that's just my opinion on what needs to happen. I may say you need to try this sort of food. Again, totally subjective, my opinion. Need is a very broad term. But if we look at it in terms of just making some assumptions, we can narrow things down and put quite a bit of fact behind it. So the two assumptions we're making in trampoline trading in this strategy is, number one, short sellers are like us and want to make money over the long term. So they're no different. They're in the market to make money, and the way you make money over the long term is just simple trade management. You got to cut your losers when you have them. I think that's a very safe assumption that short sellers are just like us and they're here to make money. However, if number one is not true in this assumption, then we have another kind of what I like to refer to as a fail-safe, and our strategy is still totally safe. So as weird as it would be if number one is false and not true, let's just assume that somebody doesn't care about making money or whatever, then we have number two as our fail-safe, and that's going to keep our strategy still completely safe, and it doesn't affect anything. And that is because we have a good friend, in fact probably our best friend as longs, and that is known as margin calls. So again, need being defined as these are very obvious areas where a short is going to be selling, or is going to be buying, excuse me, they're going to be buying because they want to preserve their capital. So obvious areas where we know shorts are going to be trying to buy their shares back so they can return them to the lender. So what is our good friend here, the margin call? Well, let's go over what this is, because it is an important concept for you to just understand. When you're in the heat of the battle trading, not so much, but just understanding this concept is going to make you understand the strategy better, and when you understand the strategy better, you're going to have more confidence in it. So a margin call is when the brokers, remember that's the lender, puts a demand on the trader or the borrower using margin to deposit additional money or securities so that the margin account is brought up to the minimum maintenance margin. So this right here, the minimum maintenance margin, that's going to be established by the broker. They all have their little kind of formulas, their little equations that are going to determine that. But if somebody is short, someone being the trader who is the borrower, and they're using a margin, which you have to in order to short, then they are going to be required to either deposit additional money, so that's option number one, or securities. So they can do something with their securities, and this is the one that we're going to usually bank on, because they may have some additional money. However, even Warren Buffett is going to have a finite amount of money, so they can only deposit money to a certain to a certain period in time before they simply run out. Then that's where they'd have to transition over to the securities. So keep in mind our minimum maintenance margin. So once the account value, so of the short trader, of the borrower, depresses to a value that is whatever is determined by the broker, then things are going to start to get nasty, because what's going to happen is the trader is going to receive a margin call from their broker, and if one or more of these securities had shorted, decreased in value past a certain point, the trader will be forced, so keyword here, they don't have any option, to either deposit more money, which we've already talked about, or they're going to have to sell off some of their assets. And in this case, their assets are going to be their stocks. And selling off assets, meaning to increase their money in their account. In this case, because they're short, they're not going to have to sell off stuff, but they're going to have to start buying to cover their shorts. So just to recap everything, let's say are in the one example where 99% of the time this isn't going to be the case, just because traders are going to want to be buying on their own to cover, because they understand, hey, my portfolio is going up in smoke. But let's say that a trader says, you know what, no, I'm going to just still dig in. So at some point in time, they're going to get a phone call or email or whatever, however their broker operates, and say, hey, this short position, it has reached our critical point where you need to either put more money into the account so we can still support and lend you these shares, or you're going to need to just buy these shares back so you can return them to us. And at that time, it is no longer it's not in their control. The only thing that is in their control is whether or not they're going to deposit more money, or in this case, buy shares back so that they can raise money that way. And us sitting on the other side of the fence, knowing that that's going to be their two choices, because this is finite, more often than not, they're going to have to buy back shares, and that's just going to keep pushing up the price higher. So margin call at the end of the day is just our fail-safe plan that is going to ensure that these short sellers just can't sit and wait and wait and wait. Whereas remember, if you're us as longs, we can sit there and hold for as long as possible, because if we put in $1,000 and are willing to lose $1,000, then we can just wait forever and ever and see if it ever goes back up, or if it goes back down to zero. Not that no sweat off our broker's back. It was our $1,000, so that's just the way it is. But with shorting, and because shorters have to use margin, this enters us into this whole thing where the brokers got to watch their back too, and the brokers have strict guidelines, strict stuff. So that's going to cover us. I spent a lot of time on this slide, but this is a very important concept, because it should give you just a sense of I don't know if comfort is the right word, but it should just allow you to know that everything is tilted in our favor in terms of when these squeezes start to happen. They're going to need to cover, because there's somebody looking over their shoulder saying, hey, if you're not going to do it, we're going to do it for you. And that's the big driving force. So to just sum things up, because this is such an important concept, the need to buy back shares is always going to be there, whether it is voluntary on the trader's part or involuntary when the lender performs a margin call. The one aspect we know will happen is buying. That's why short squeezes, when shorts are getting squeezed, that's the one thing you can count on: buying and more buying. Yes, the buying is going to run out at some point, but we'll cover all that stuff. But the point being, there's going to be buying there, because shorters don't want to lose money, and their brokers sure as heck don't want to lose money unless they want to go out of business. So they're going to be on their clients' back saying, hey, do these, here are your two options, do one of them, or we're going to do it for you. So buying will be taking place, and us as longs, buying makes the price go up, and that's what we want to see. So now let's talk about some phases. The very first phase of any sort of situation where the shorts are going to get squeezed is simply the building phase. Why are people shorting? Well, people could start shorting because there's bearish outlook. Maybe they're listening to CNBC and analysts are saying stuff. Maybe they're looking at the technicals, not the technicals, but the fundamentals, the balance sheet, cash flow, revenue, all those different metrics. Maybe they're just simply bearish on those. Maybe they're bearish on the technicals, just technical traders saying, hey, I see X, Y, and Z happening. I think this would make a good short. But for whatever reason, people are shorting. And I know this is an advanced course, so you should know this, but I did want to remind, as technical traders, we don't care about the why. I don't care why people are shorting. I just care that they are shorting, that something is happening. So just keep that in mind. You don't need to figure out for this strategy why people are shorting. If you want to, fine by me, but I'm all about saving time. That's why I use charts, because the why doesn't matter. It's just the is that matters. So just keep that in mind. There's going to be nothing in the strategy where we have to go and start digging through SEC filings or anything like that. And then who are the builders of the formation? And that can be anybody. It can be the hedge funds that are having bearish outlooks. It could be just you and I, retail traders, for whatever reason. And it can be the institutions. Point being, it could be, your next door neighbor. It could be, the person down on Wall Street. But people are shorting, and that's going to show up on the chart. In this example here, you can see that the price topped out right there. So this is when the bearish thoughts arose. Again, what brought about those bearish thoughts? Who cares? We just care that there's been bearish thoughts that have arisen, and now you can see the shorts begin to take over, and this, it begins to trend downwards. So this gives the shorts the green light. Hey, look, our strategy's working. Look at this thing trending downwards. I'm going to short. And at this point in time, I don't blame them. From a technical perspective, lower highs and lower lows, yeah, that's a downtrend, and the trend is definitely in the favor of the shorts at this stage of the short squeeze. So during this time period, the overall short position is built. Now, hopping back and putting on our just psychology hats, at some point in time, the reason to short begins to decline. So people's feelings, people's emotions change. Now, most likely, this is going to be by the technical traders because they see something on the chart and are saying, hey, this isn't as obvious as it was previously, so I'm going to cover my short and buy back some shares. Fundamental traders at this point are still feeling pretty good. They're the fundamentals, the balance sheets, all that stuff that they're using, that's still staring them in the face, saying, hey, it's still bearish, no need to cover, you're doing fine. And rightfully so, because this could simply be just consolidation period right here. Where it's just kind of taking a breath before heading back down. So the fundamental traders aren't wrong. The technical traders aren't wrong. You're never wrong. When a stock is simply going sideways within an overall trend. So people are starting to be cautious here, but they're not getting any sort of price action or anything where it's going to say, hey, there's a need to cover. Right now there is no need. Might it be smart to take some off the table? Sure, but as far as that need is concerned, shorts aren't losing any money. Maybe day trader shorts are here, but as far as the overall chart is concerned and the overall position that has been built during the building phase, it's starting to lose momentum here, but nobody's spirit's broken, and they're just being cautious here. So transition phase is all about being cautious, saying, hey, things might be getting ready to turn around, both from our perspective as longs and then shorts. Everybody is being cautious. This is where both shorts and longs are on the same page, saying, hey, have to keep a closer eye on it. Maybe things are getting ready to turn around. Now, this is the exciting phase here, the trigger point phase. And this is where some event occurs that causes the short squeeze trigger to be pulled. Now, that could be a surprise outlook upgrade. So maybe everybody was thinking, oh, this analyst so-and-so is going to be downgrading it. And then all of a sudden, boom, they have some sort of positive outlook, and so they upgrade the stock that catches people off guard. Maybe there's just simply some unexpected bullish news. Company signs this or does this or that. You understand that there's all sorts of things that could happen, but the point being, it's unexpected and it's bullish. Obviously, people have been feeling bearish, as we've already established. So if something unexpected bullish comes around, maybe a large institution just simply changes their internal strategy, says, you know what, we're going to cover our short position here and move over to company X over there. And this little thing could start to trigger, because remember, to cover, they're going to have to buy. So if they start to buy and the price starts to creep up, maybe that's going to trigger other people saying, hey, I better cover my short position too. Look, the price is starting to creep up. And then before you know it, we have a major problem there's a major problem going on. So one more just quick reminder, and I'm not going to spend much time on it. Remember, as technical traders, we don't care what the event is. We just care that something is happening. So the event, sure, if you want to go and figure it out, go for it. But me personally, I don't care what the event is. The chart's telling me that something is happening, and that's the only thing that's going to make me money at the end of the day. So one of these events, maybe something else, I don't really care, but the point being, some event happens and it starts to cause the shorts, and it gives the shorts the need to cover, and that's going to present a major problem here. So this major problem, Luckily, I'll tell you up front, this major problem is not for us, but it is for our good friends, the shorts. So we're just going to recap it here, and that way you can kind of understand what exactly is going on. This is basic stuff, but still, just kind of think about this and think about if you put yourself, into their situation. So remember, during the building phase, there's been a boatload of traders who have been shorting during this phase. Transition phase, probably a few more, but during that building phase, when that downtrend is very obvious, there's been a lot of people going short. It's been a bearish environment. There's been a lot of people that are saying, all the talking heads, all the blog articles, I'm sure, have been bearish. So, and maybe rightfully so. Maybe the company deserves it, and that's fine. But the point being, environment has been bearish, and when everybody's thinking something is bearish, everybody's going to be shorting, and that shorting has driven down the price. Again, shows up on the chart. This just simply creates a large amount of shares that have been borrowed. And remember, these borrowed shares must be returned. Because there is a limited amount of shares at each price level, the amount that can be bought at that price level to be returned is limited. That's just basic stuff. When you watch level 2s and you're looking over at the ask and the ask starts to disappear quickly, that's just telling you that those sellers, there's nobody left at that level to sell. Nobody's willing to sell. So again, I'm not trying to insult your intelligence, but just picture level 2 asks. When you see those big moves happen and the asks on the level 2 just keep disappearing and disappearing, that's a concept right here. So at the beginning, the shorters, they probably still have some profits, depending on where they shorted, of course, but let's just assume that they do have profits. At this point in the early areas of the squeeze, they're watching their profits dwindle. So really, they have no choice. But hey, my profits are dwindling. I got to lock in some profits here. So I just got to pay a higher price. I wanted to get this price, but that price is gone now. But instead of watching my profits evaporate, I'll just pay at this higher price, even though I didn't want to. So they start paying at higher prices. Well, with each buy, you understand this. This pushes the price level even higher that sellers are willing to let buyers purchase at. So now the shorts are thinking, oh crap, I wanted to buy there. Then I decided I want to buy there, but because other people beat me to the punch, now the ask on level 2 is this. I'm going to try to buy that. So pretty soon now, this goes on long enough where shorters that had profits see their profits disappear. And now it gets even worse, because with each and every tick, their losses are growing. So it's transitioned from, oh, my profits are dwindling, I don't want that to happen anymore, I'm willing to just buy back at a higher price, to now all my profits are gone. Now with each and every tick, my losses are growing. So that's where this guy enters into the formula right here. Now people, the shorts, are starting to get really nervous, because not only are their profits gone, now it's a matter of their portfolio going down in value. So at this point, this is where the need comes in. Shorters have no choice. They either need to buy, or they need to attempt to buy shares on the open market, and so they can return those shares, or our good friend shows up, the margin call, and is going to force them to sell some of their assets. But because they're shorts, they're going to have to cover the short position at any cost, meaning, hey, you got to buy back these shares, you owe us shares. Remember, their broker themselves could have borrowed them from another client or another brokerage, so they're sitting there saying, hey, we need those shares, you better liquidate. And that's going to force them, that's going to bring about the need to buy, and that need to buy is just going to continue to push up the price on the level 2s. Those asks are just going to keep disappearing and going higher. So this problem leads to something right here, our gain. So that's the beauty of all this is, make no mistake about it, squeezes are extremely unpleasant. However, they're unpleasant not for us. But let's put ourselves, think about this. Have you ever tried to buy a breakout or a bounce and you struggle to get filled at the price you want? If you say no to that, I'm pretty sure you're lying or not being honest with yourself, or maybe you just don't have a very good memory. But I can think of multiple times where a breakout happens or something happens and I just can't quite get filled at what I originally wanted to, so I have to pay a little bit more. It's frustrating. It's very frustrating. But hey, think about this. At least it isn't costing you anything. Imagine this. Imagine if every time you try to get filled as a long, it meant you were losing more money. Well, this is the shorts, and this is what sends them, and justifiably so. Remember, they need to buy into panic buy mode, and panic buy mode is just going to keep forcing the price higher and higher, because every time they're trying to get that filled so they can return those shares, the sellers on level 2 bump up the price even more and say, hey, now if you want to return the shares, you're paying this much. Oh, sorry, now if you want to return the shares, you're paying this much. I mean, how frustrating would that be? And quite frankly, how depressing. So is it cruel to benefit from these people's misery? Not at all. I don't want you to feel bad about it now that you kind of understand each and every step, because remember, it's the open market. Sometimes the shorts are gaining from us as longs paying. So what better way to benefit from their pain than finding where they're getting squeezed, and then quite frankly just exploiting that and making them have to pay higher. Because remember, when we're buying shares as longs, we're taking away their opportunity to buy at that level so they can return the shares. If there's 100 shares left at, let's just say, $10, and I come along and buy them as a long position, now the short who is hoping to buy those same 100 shares, they're gone because I just bought them. So now they're going to have to pay a higher price. So not only are shorts competing against themselves in a short squeeze, they're just competing against other longs that are trying to enter into the position. So that's just where things really get crazy, and everybody's in a panic buy mode. Momentum traders are going to come by and say, hey, look at this thing. Bounce traders are going to come by. Breakout traders everybody's going to come by because everybody likes to see a price going up. So kind of went off on a tangent there, but bottom line, do not feel bad. It's not cruel at all because they do the same thing to us when stocks are falling apart. Remember, during the building phase, they were shorting that thing down further and further and further, and they were longs losing money during that. But this strategy revolves around, and we'll get into all the details here, waiting for things to start to transition, and then that's where we, with our strategy, look to start to take our opportunity. Now, there is no such thing as a risk-free setup strategy, whatever you want to call it. So the one risk that we have to acknowledge is that the overall environment for charts like this is bearish. Remember, there's reasons that people are shorting. What those reasons are, we don't really need to care about, but we do need to acknowledge the fact that there is a reason, and it exists, that this is a bearish environment. Now, should this scare us as traders who are looking to go long? Absolutely not. But should this provide a blunt reminder to be disciplined with our trade management, meaning honor those stop losses, put those stop losses in place? Absolutely. So I don't say this to try to scare you off from the strategy. I'm just bringing it about because, full disclosure, there is no such thing as a risk-free strategy. We're in a bearish environment. Can this bearish environment quickly transition to the bull's favor? Absolutely. But at the same time, is it always going to transition to the bull's favor? No. If that was the case, I'd be a zillionaire. Everybody would be a zillionaire. So there's no such thing as a 100% guarantee. But when we know what to look for, we can minimize these risks. But the risks are always going to be there. So we just need to remember and let this be a reminder to us that we need to practice that disciplined money management. So let's go through some examples here just real quick before we get into them. They're going to be broad examples. You might be wondering, well, why did you buy there, or what made this, or what made that, or how does this function with that? Don't worry about any of that right now. We're going to get into that in future videos. Right now, just want to show the overall psychology, all three phases, how they work together. We'll dissect things going forward, but for the time being, so don't think, what kind of crap is this? You're not giving me any details. Details will come later. So with this example here, you can see that right here is where the chart topped out. Bearish thoughts, whatever those thoughts are, who cares? But point is, shorts begin to come in. The environment turned bearish. So that gave the shorts the green light. Hey, this is a great short. And you can see here with these lower highs, stock drifted downwards. So building phase here, shorts taking place. Then all of a sudden right here, you can see a couple higher lows, transition phase. Everybody's being cautious. So longs are being cautious. We would be cautious in the sense of, hey, something may be turning around here. Shorts would be cautious. Hey, maybe something's turning around here, so I might be having to look to cover my short just in case anything happens. But at the same time, this could simply just be a consolidation move before it's heading lower. But we do have the transition phase here, and we know it's a transition phase now because hindsight's 20/20. But at the time, everybody needs to be cautious here, but no need to panic in either direction. However, right here you can see this would be the trigger point, and from this point forward, this is where the squeeze began, and the price just gets shoved up. People fighting over shares. These people are, hey, my losses are gone. Now I just got to try to get out. Margin calls could be occurring, but point being, this is where the major problem happens. But for us, it's not the major problem. This is a major opportunity. But for those shorts, they got a problem on their hands here as the price, price action, doesn't that's not the point of this right now, just the price movement. So you can see very quick move upwards as all these people that were building the short, now all of a sudden they're getting squeezed because some sort of surprise, something happened right here that made the tide turn, and now they're feeling the pain. So a second example here, again, something happens that changes the environment over to bearish. Gives people those bearish thoughts, so the shorts begin to take over. You can see here these lower highs. So straight up building phase here, the shorts have the green light. Look at this, technical traders, fundamental traders, all the talking heads on CNBC, this thing's a piece of crap, blah, blah, blah. So the shorts are just shorting. Some of them are making money. The institutions are probably building some pretty big positions, whatever. That's all speculation on my part because, the chart isn't going to tell you who's causing all this, but all it's going to tell you is that it is happening, and that's all that matters. So for whatever reason, environment is bearish. And then we enter into the transition phase here. Stuff begins to bottom out. So this puts everybody in caution mode. Shorts are thinking, all right, things could be changing. So there's still some shorting that's happening down here, but not as much as what was happening during the building phase. And then right here, some event happens that all of a sudden triggers this move here. And this is the trigger point. People start to watch their losses go away. So this enters into the red light thing where people are like, all right, stop shorting, start to cover, and that's what happens. They start to cover, and you understand the psychology and steps behind that, so you can see what happens here. Trigger point, and then the price really begins to head up as the shorts fight against themselves and against longs trying to enter in, and against us, I guess, because we're looking to enter in. So shorts are fighting against not only themselves, but now they got to fight against us who are trying to do some trampoline trading. Final example here, pretty darn similar. Hopefully you're seeing that all these have common characteristics here. Bearish thoughts take over, price starts to head back down, and then you can see here that we have transition phase start to take place. This one takes a little bit longer in time, so I wanted to bring about that point. There's no set time frame. There's if you personally want to do a set time frame, that's fine. But as far as how these squeezes operate, it can take multiple weeks. It could take a few days. If you're looking on a intraday time frame, it could take just a few hours. So they happen over all sorts of different times. This one you can see the building phase wasn't too long, and the transition phase was actually a little bit longer. But you can see right here the squeeze, whereas those other examples took a little bit longer to unfold. This squeeze happened extremely fast with a trigger point there, and then basically, let's see, 1, 2, 3, 4, 5, 6 days later, it went up and hit its high. So on that point, the squeeze formation can take a multiple amounts of time, and the squeeze itself can take multiple amounts of time. Extremely fast, extremely long, right in the middle. There's just no, I'd be lying to you if I said all squeezes happen in X amount of time and then the squeeze portion happens in Y amount of time. That would just be a lie. It all varies, so keep that in mind. But again, you see the psychology. Building, transition right here is where that trigger takes place, and then the price. This would be a very painful one to be a part of. Obviously, there was quite a bit of shorts here, and they wanted to fight over things quite a bit, and that pushed the price that much higher. So, again, what that event was, I have no idea, and I have no care in the world. All I care is there was some event there, and that gave the shorts the need to cover those shorts and buy back, which created a major problem for them. So that's going to wrap up this. Hopefully now you understand what the anatomy of a short squeeze and why it can be so valuable to us when we go and exploit somebody else's major problem.